watching Bloomberg Quint. We're here in Davos. The WEF's annual meeting hasn't officially kicked off, but our work's begun. Today we have with us Simon Smiles. He's the Chief Investment Officer of UBS's Ultra business. That's the ultra high net worth business. Simon, I had to explain that. Thank you so much for speaking to us here.
Thank you.
Okay, I'm going to start with a contrarian note. I know you'll put out a white paper and I'll get to that in just a bit, but my drive up here in Davos, all I could read about on social media was this Oxfam report that said that the rich got richer last year and the poor got poorer. And that sort of, has cast this pall of gloom across Davos, as many people on social media would suggest. Let me give that a twist. This business of the rich getting richer, are you seeing it play out in financial markets, and therefore what would your outlook for 2019 be?
Well, in 2018, most listed financial markets actually saw significant, in some cases, declines with respect to their prices and values, and almost all listed financial assets saw some decline. On top of that, you had a strong strengthening of the US dollar against most currencies, further impinging on the wealth of people with currencies, home currencies other than US dollars. I wouldn't necessarily say poor people got poorer last year, though. Nor did rich people necessarily in aggregate get richer.
Sure.
So, yeah, I take a step back maybe from the Oxfam report. Looking forward, though, I do think we're at an inflection point. Much of the last 5 to 6 years has been about fundamentals. Earnings fundamentals, economic fundamentals. Now we're entering a stage of the cycle, increasing this year, where I've expected to continue to see volatility as there's more and more focus on both policies with respect to central banks and also politics, such as the US government's shutdown.
Oh, fair enough. We just heard from the IMF that updated its World Economic Outlook to suggest that 2019 is going to be a year of slightly slower growth than they had anticipated even as late as October 2018. And advanced economies are where we're going to see that slowdown play out the most. I'm just wondering, do central banks have enough monetary measures at hand? Do governments have enough fiscal stimuli at hand? And if not, and what happens to financial markets this year and next? Are we only talking about volatility, or are we talking about a sort of sustained slowdown, generally speaking, across asset classes, that sort of keeps pace with what's going on in the economy as a whole?
I think what we've seen in the last 6 to 12 months is very much what we're likely to see this year, volatility. Towards the end of last year, there was too much pessimism. We were still seeing growth. So while next year's growth economically is expected to be slower in the United States, in China, in Europe, in Japan, we still are expecting growth rather than recession. Okay. Equally, this year has seen sharp appreciation in many assets, which is probably a little overdone. But the only part of your question I'd challenge slightly is, again, it's not just developed markets that are starting to see slower growth. It's actually most large economies are this year likely to see slower growth. Still growth, but slower growth.
You're referring to China, I would imagine.
Exactly.
Yeah, okay, fair enough. I should have qualified that a little better. What are your clients telling you about the kind of confidence they have across asset classes? What do you think will be stand out this year?
Well, I think when we talk to clients about their businesses, so the private entrepreneurs that we speak to, there's a growing concern about policy uncertainty. Not as much interest rates. I think now increasingly people expect the US Fed, for example, to not necessarily put up Fed funds this year by 2 or 3 times. There's more of an expectation if we get a further rate hike, it's more likely to be just one this year. But I think there's a growing concern about policy, trade policy between the US and China, and the uncertainty and the length that that uncertainty has been lasting. And secondly, uncertainty which is increasingly growing in the US about their government shutdown. To date, it hasn't created a huge issue for the US economy. If this continues to go ever further, you actually are likely to see an acceleration in the impact that has. So I think they're the concerns, particularly the entrepreneurial clients with US and with global trade related businesses. Where people are looking for opportunities, it's less going into mainstream investment mandates, mainstream equities, etc. Increasingly, the clients that we're speaking to are still interested in having a diversified portfolio, diversifying away from local currencies, but increasingly asking us questions about sustainability. And that is part of the reason we published the white paper you mentioned that we did this year. Because while there's a lot of appetite from clients to engage in sustainable investments, it's investing in sustainable investments if they have a positive impact and have the same or better financial returns as traditional investments.
So we've been hearing of this for the last few years now. some may call it a fad, others may call it a trend, but there is no denying the interest now in wanting to be able to invest in a portfolio of sustainable investments. In your experience, how large a portion has it become of the kind of various asset categories that your clients invest in? Is it still substantial, or will that take time to happen?
Well, last year's WEF, we announced plans to launch the industry's first true 100% sustainable impact investing portfolio. So rather than high-grade debt, we replaced that with with World Bank debt. All of the individual allocations in the equity side are to sustainable investing equity allocations. Okay. In the fixed income, green bonds and high ESG rated companies. Over the last year, we've seen significant growth despite the broader issues with financial markets. A tripling of assets, it's up to $4 billion, inflows over 90% of the weeks last year, and great financial market performance. However, that's still $4 billion across a asset base that we have of over $2 trillion. So it's a starting point. More broadly, the appetite for sustainable investing among clients tends not to be as much about we want to invest in high ESG, it's we want to help cure water issues or waste issues or climate issues. And that's where there's a big breakdown across the industry as a whole. The preponderance of sustainable investing instruments which are currently available are on aggregate basis. They're not on personalised basis. So another thing we're looking to do this year, and part of the white paper, is to increasingly call for people to actually have recommendations in the sustainable space that not only expected to make high financial market performance, but also have a positive impact on something specific or a range of specifics that clients care about. And not every client cares about the same things. Do you care about climate change? Do you care about poverty? Do you care about waste? Do you care about pollution? And. If you can map out exactly what clients care about and then model their portfolio and their allocations exactly to those specifics, it'll be different for one person to the next. I think it's a huge opportunity in getting more and more capital into sustainable investing because it's much more understandable for the end client than a high ESG company, an aggregation that someone else imposes.
Okay, fair enough. One last question and then we'll return you to the heat, as they say. Do your clients talk about India at all? I'd be remiss if I didn't ask where it features, not just necessarily in the sustainable development portfolio, but across asset classes, in emerging market equity classes as well.
Well, very much so with our Indian clients and with many of our Dubai and Abu Dhabi-based clients. More broadly, no, there's less focus, I'd argue, on Indian assets than there perhaps was 4 to 5 years ago. Okay. Instead, there's a lot of concern when it comes to emerging markets about China and a bifurcation. Some people continue to think that Chinese assets are very attractive, some being much more concerned. More broadly, the interest in Asian assets, equities, is probably less than, again, it was 4 to 5 years ago. So again, more of a China focus, more of a US focus, more of a European focus in terms of assets across our broader client base than Asian as a whole or India specifically.
What would you put down to that? Why do you think people have lost interest in India? Is it simply because of political uncertainty, or is it any other economic related factor?
I think it's a huge amount of interest when you had political change, fundamental political change about what could have happened. Understandably, you haven't had the kinds of incredibly optimistic expectations pan out, and so focus has increasingly gone to China and to the US, two very large economies, each with a lot of headlines, both positive and negative, each with a lot of government support and also government detraction. And so the focus has tended to move to that rather than continuing to hope that there was fundamental and material and very quick accelerated change in India.
Fair enough. Simon, thank you so much for finding the time to speak with us in Davos. Have a good week and get back into the heat. Thank you very much.